The second learning objective is to distinguish among operating, investing, and financing cash flows. There are three basic types of cash flow activities. The statement of cash flows has a section for each. They are operating activities, investing activities, and financing activities. Operating activities is the most important category of cash flows because it reflects the day-to-day operations that determine the future of an organization. These activities create revenues, expenses, gains, and losses, affect net income on the income statement, and affect current assets and current liabilities on the balance sheet. Investing activities increase and decrease long-term assets such as computers, software, land, buildings, and equipment, and include purchases of sales of these assets plus loans receivable from others and collection of these loans. Financing activities increase and decrease long-term liabilities and equity, including issuing stock, paying dividends, and buying and selling treasury stock, and they include borrowing money and paying off loans. To summarize, operating cash flows affect the current accounts. Investing cash flows affects long-term assets. Financing cash flows affect long-term liabilities and owner's equity. There are two ways to format operating activities on the statement of cash flows. The indirect method, which starts with the net income and adjusts it to the net cash provided by operating activities, and the direct method, which restates the income statement in terms of cash. The direct method shows all the cash receipts and all the cash payments from operating activities. The indirect method and the direct method use different computations, but produce the same amount of cash flow from operations. They have no effect on investing activities or financing activities. The indirect method starts with net income and adjusts it to the net cash provided by operating activities. Note that the net decrease in cash is $20,000. The direct method restates the income statement in terms of cash. The direct method shows all the cash receipts and all the cash payments from operating activities. Note that the net decrease in cash is $20,000, the same as the indirect method. Short exercise 14-3 asks you to classify items on the indirect statement of cash flow. An increase in accounts payable is at an operating activity, investing activity, or financing activity, or an activity that is not used to prepare the indirect method of cash flows. Increase in accounts payable is a plus in operating activity. Payment of dividends is a minus in financing activity, or cash out. Decrease in accrued liabilities is a decrease in operating activity. Issuance of common stock is an increase in financing activity. Gain on the sale of building is a decrease in operating activity. Loss on sale of land is an increase in operating activity. Depreciation expense is an increase in operating activity. Increase in inventory is a decrease in operating activity. A decrease in accounts receivable is an increase in operating activity. and purchase of equipment is a decrease in investing activity.